Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, and it's September 26th. We got a couple items here on the economic calendar. We'll start off with what we get every Thursday, and that is weekly jobless claims. So last week it was revised slightly higher. It was at 208, and it came in at now it's at 210, revised about 2,000 higher. That's important primarily because last week's jobs reports were or the data for the weekly jobs claims is going to be used as a component for the jobs numbers for the month of September. So when we get the sample week, it is an important number primarily because that is going to be a component in their calculations to formulate what will be our jobs numbers. And well, I mean, a low number like that could help us out to basically state that there will be a strong jobs number for the month of September. So that's going to be one of the things that will kind of like a prelude to what we might expect in terms of jobs when they release it here on October 4th. Now, the forecast for this week is 211,000, and it came in at 213,000. So this basically tells us again that jobs are still in a pretty strong demand. We're still getting relatively low people applying for unemployment. People are getting laid off less, and we are seeing a growing number of participation rate increasing a little bit. So that's a good sign there as well that more and more people are jumping uh, into the game, so to speak, and you know. Participating. Obviously, one of the things is that why employers are reluctant to letting people go is that there's not a lot of people out there to rehire and such. So they're trying to retain their employees. So one thing we're also seeing is that we're seeing a little bit of an increase in wages as a result to keep to hold their employees as well. Now we also got the GDP revision. This is the final revision for the Q2. And as you can see, it remained unchanged. It was at 2% of the last reporting. Forecast come for a slight increase to 2.1. However, it did remain unchanged at 2%. So Q2 came in at 2%. And last but not least, we got the pending home sales for the month of August. So we had back in July, it dropped 2.5%. Now, forecasters come for a 0.9% increase in August, and it exceeded that to 1.6%. Now, probably a part of this is that the rates have been kind of dropping a bit, and that's probably helping a little bit further in terms of people getting out there and buying more homes, helping them with affordability. So this is probably one of the reasons. Plus, we're getting towards the end of the summer here in August at 1.6%. So obviously, that's a great number there. What we're looking at. Also, the West has been kind of lagging a little bit, and we saw uptick in those. When you look at the micro numbers, we saw an uptick in the West, increase in those numbers as well. So that's a good sign for those out West as well. So let's take a look here. Headline news: stocks are down today. Yes, we got the impeachment talk that's on the table. We got China-U.S. trade talk, and later today, again, yeah, like yesterday. This is mostly like yesterday. There'll be more Fed speakers speaking later on today. Now, yesterday, they kind of took the good news of the U.S.-China trade talks, and that's what kind of rallied the markets a bit more. And basically, as we've been seeing that China and uh, is placing more orders. We're seeing like soybean and pork orders increase before the trade negotiations or talk in mid-October. So things are looking kind of rosy there, and President Trump even kind of made a statement yesterday that this trade war or negotiation may be finished sooner than later, and that kind of helped rally the market a bit even further. So they downplayed the impeachment talk yesterday. However, today on the other end of it, the impeachment talk is kind of making them a little bit more jittery. As a result, we're kind of seeing a flight to safety in some cases to the mortgage-backed securities today. Now, yesterday, as the stock market heated up, the bond market tanked a bit more. We closed down 33 basis points. So we did break below that whatchamacallit, that pennant that we were talking about. However, to the wrong side is what we're hoping to break upwards, but instead it broke downwards. So now we're down below the 50-day moving average. We got a good 50 basis points lower that we could initially fall before it could get better. So right now we're up about 11 basis points. Not quite better pricing, but about the same as where we left off yesterday. So if this can continue going upwards, it could help us out. But now that 50-day moving average that was our floor of support for a few days now is going to be our ceiling and could make it more difficult. And as you can see here, the 25 is coming down, the 50 is moving up. At some point, we're going to have a double ceiling there, and that can make it even that much further, more, or not further, but much more difficult to get through as well. So as you can see here, we're kind of seeing almost a possible crossover here in the stochastics, and they kind of almost merged together here. So this is something we'll want to watch as well. Now on the yields have kind of dropped a little bit today. We're down to about, we're going to round up. It's like a little bit under technically, but it's about 1.69. We saw a big rally in the yields. Spreads rise quite a bit, almost to the 50-day moving average here. And as you can see, the same thing. It's kind of converged, almost a possible crossover. So this is something we'll want to watch going forward here. Now tomorrow is going to be a big day. We got inflation news coming out, the PCE, which is the Fed's favorite gauge. Now this is something that could spook the bond market primarily because we kind of saw a slight uptick in the CPI report, so we could potentially see the same in PCE. This is called the personal consumption expenditure. And if we do see that, that could spell bad news for bonds because we're seeing the Fed kind of cutting rates. And cutting rates is kind of one to stimulate the economy and thus also stimulate more inflation. And the last thing bonds want is inflation growing. And because what happens is when you look at bonds, it's over like a 30-year period. And when you see inflation going up, it erodes that value, and that's what's kind of what spooks the bond market. So let's kind of jump ahead here. Well, that's pretty much a wrap, actually. Mortgage rates are unchanged from the close of yesterday. So if people did not price for worse yesterday, they will put the worst pricing in today. Those who did price worse should have about the same rates what we saw at the close of yesterday. All right, so if you guys are looking to buy a refinance, please reach out. I am a loan officer with the Pinnacle Home Mortgage, our home loans. We do offer a wide variety of loan programs that can provide the best solution for your scenario. Best way to reach me is direct message me or email me. My message up ahead, or direct message me from where you're seeing this, and we can certainly talk a little bit about how we can help you out with your scenario. All right, folks, you guys have a great rest of your day. Thanks so much for watching. I look forward to see you guys tomorrow. Bye-bye.